right, so we're preparing to go live here. And when we do that.
Is there a link for this?
Only after the thing is set up. So right now there will be in about, there we go. So now there will be. Yep. All right, so cool.
I still see you.
All right, good. Let me,
so preparing to...
All right, can you hear me?
I can hear you.
Mar, you hear me? All right, good. You hear me?
Yes.
Okay, cool. All right, folks. So we are live on YouTube on a day of excitement. The VWO is down 11%, Amar. Small caps down 9.7. Let's see. Even Ginnie Mae is down. Actually, I was kind of surprised to see the government bonds have fallen off quite a bit over the last couple of days too. So let's see. The S&P 500 is down 8%. So we're at 25.23, not quite in 30% range, but we're getting there. We need to be about 23.50 to be at 30%. But so, folks, let me just reintroduce you to Amar. It's been probably a good 6 months, and maybe not that long, but a while since we've last. Hold on just a second, Amar. I'm just trying to get this set up on this side.
Yeah.
It's probably been at least 3 months since we last spoken live and in person on the YouTube channel. And I felt Amar and I were talking, my friends, about the what shall not be said, coronavirus investing and stuff like that. It was just, he has an interesting take. So remember, guys, I have no affiliation with Amar. He's just a friend of mine. We knew each other from USAA. We worked together for many, many moons, and he's just a good guy. He's out of San Diego. He runs money, invests money for clients all over the good old US of A. He's just a good guy, but I get no affiliation. We have no, quid pro quo, whatever it is, anything like that. So if you're interested in Amar managing your money, don't look to me. Just go straight to the source, because I can't, I just don't know. It's up to him and you to make that arrangement for sure. But Amar, tell us, just give a quick background again, just maybe a small one for those who are new to the channel, who you are and stuff like that, so people can get a gauge of who my man Amar is, if you would.
Yeah, so my name's Amar. My formal education is actually in engineering. I'm a EECS degree, and I like investing money. So I started, investing money through mutual funds to exchange traded funds, and then got a job at American Express Financial Advisors, to JP Morgan, to USAA. And I recently just launched my own firm last April. So I am the chief investment officer for my firm, and I have some thoughts on the market. Josh has some thoughts. We don't necessarily agree on everything, but I think we have a common theme, and I think it's good to kind of explain that to individual investors.
Absolutely. Absolutely. Are you getting a lot of calls just right out the gate, Amar, from clients who are freaking out, or what do you think?
Fortunately, we're not, and it's not. I want to say this is kind of lucky. It's actually not lucky. It's about having a disciplined process. So the week before Thanksgiving last year, we did a big rebalance, and in any election year before November 6th, you're going to have a lot of volatility.
Yeah.
And because of that, we carved out some cash for the individuals that are taking cash flow on a monthly basis. And actually, the conversations that we're having now is, how do we get some of that cash flow back in? And the truth is, nobody knows. There's no crystal ball, but you have to have a disciplined process in order to get ahead. You always need to have liquidity to make sure that you have a safe place to access capital, and then follow a disciplined process for the rest of your dollars. So, right now I'm able to do this video and be here with you and talk to other people, because if you're worried about the markets right now, you probably have too much in equities to begin with. You're probably over aggressive. And I have a couple slides here, Josh. I think maybe
before we jump in that real quick, Amar. So you said discipline 3 times. What exactly do you, I hear that a lot, not just from you, but other people. Explain what you mean by discipline, if you will.
Well, you have to have a process, right? And you have to be able to stick to your process. And that's where the discipline comes in.
Okay, gotcha. Gotcha.
And I'm going to talk a little bit more about what we're doing for our clients during this environment. And so that it could be something that people can take away and have some thoughts of what they should be doing with their own investments. But
now you're in California now, so just boots on the ground. Have you gone to a store lately? Have you? Is the oil still
yeah,
pumping? I mean, are people?
it is ridiculous. I feel it's ridiculous that we're stopping our way of life in a way that's going to hold everything
Yeah.
without having testing readily available. Testing needs to be there because it's just not feasible. I understand why we're stopping our way of life to slow down the spread of coronavirus, and stopping the spread of coronavirus helps reduce the strain on hospitals, right? There was a statistic that I heard yesterday. There's going to be 48 million people using a hospital this year. I mean, that's an immense strain on the system. And so we do need to slow down the process. And for those individuals that are 55 and older, the coronavirus does have a bigger impact than the normal flu. So we want to make sure that we're protecting, that population and older. But to say that we're going to, stop everything, I mean, that's just very, very hard to do if we're not doing testing. We have to do testing to make sure that we're stopping, hey, if you have the symptoms, yeah, we should quarantine, we should stop.
Stay home.
Yeah, stay at home, watch Netflix, watch YouTube, watch Josh and I. But if you're not feeling those symptoms, then what we're doing from a business standpoint is we're not putting safeguards in place to keep people that need to be working, that need to continue the economy out there to be able to do their job as well as they can. Now, I know a lot of companies have said no travel. Like I've had 3 of my conferences that I go to cancel. One of them was in Seattle. So, I'm thankful for that. But being in the epicenter of coronavirus, to taking the right steps. But I mean, this is how we get education as individuals in the industry. And I know work from home and Zoom and Skype and are
actually what Zoom stock is probably killing it, right? I mean, I would think.
Yeah, I mean, a lot of companies are in
4.76% today, Mark.
Yeah. People are investing in infrastructure for people to work from home, and we have the technology to do that, right? So when we look at our economy and the growth process, part of that is worker productivity. And I don't think technology is going to slow down worker productivity. I think, there are certain things like, for example, in equities, you could have a trader work from home with a high-speed internet and still be productive. But fixed income and bonds, where there's still some negotiating for price purchasing, right? You need relationships, and you need to be there and to have those relationships. So it's going to be interesting.
People are wondering what I'm doing over here. I see some comments coming down, so I'm just looking at the comments. So just FYI, my man, Tom, I think someone said, "Hey, you're not looking over at the market all the time." And I'm like, "No, I'm just looking on some comments." All right, so Mar, you got a couple of interesting graphs. Share those with us if you don't mind.
So I'm going to start with a couple of them, but I'm going to start with this. Let me know, Josh, if this is full screen or not.
That's good. Yeah, that looks good.
So I just want to point out, in history, there have always been times to sell. There's always been times to panic, right? So, NASDAQ falls 4% from season highs. Dow has the largest point decline ever up until today, and a couple of weeks ago. And then, so look, after all of these things have happened, the markets still grow.
Yeah.
Right. They continue to grow. Another thing that I want to show, and so I'm going to stop sharing this and then come over here. And I'm still getting used to sharing with speed here, but bear with me. This is a great slide, and this is from Capital Group, so American Century Fund. So if anybody out there has Edward Jones, they sell a lot of American Century funds. But this is a good slide to show because, the markets go up and down, right? the truth is that there's always uncertainty. Nobody has a crystal ball. If people had crystal balls, they wouldn't be talking to you, right? Like that's the famous saying in the investment world. So if we look at the size of declines, 5, 10, 15, 20% or more, they happen all the time, right? And the markets rebound. So what we can say is normal market cycles, once per year, you're going to see 10% decline from peak to trough in a market, right? Once every 4 years, about 15% or more. And what we're seeing now is something that's 20% or more. And does this share a different screen, Josh?
I was looking at that same. Yeah, this is a good one right here. I was looking at something just like this. I'm glad you showed that, Amar. I mean, this one right here is fantastic. Yep, there you go. Perfect, perfect.
So this shows the months duration from peak to trough, right? So for 2020, February 19th was our peak. And then, we're in the middle of it. We haven't even been 1 month, right? This is not March 19th. The duration has been less than a month so far, right? And when we look at this, look at the cumulative returns on the downside. It's something that you need to consider from a timing perspective.
Yeah.
Bear markets are not 1 month. They're not 2 months, right? You see the smallest one here is 3 months. And we're about, this level of negative return. So this one has been the fastest down so far, but this gives you some good ideas. Josh, you have any thoughts on this that you want to add?
I do. I find it, I was looking at something just like this. So keep this up there real quick, Amar. But if you look, the ones in the bear market, I guess a bear market, but the Black Monday, 825.87 to 12.487, the market was down 34%. 22% of that was in one day, and yet in 87 we still had an up year for the year. Of course, 88 was good, and then we look at 2000. See, the one thing that I wish that this doesn't show from 2000 until 2002, but actually the market fell into to March of 2003. We had a dead cat bounce. Then we had a drop again to about March of 2003, and I think a lot of people in hindsight, they look past how deadly that it felt, that dead cat bounce, when the markets fell again in March of 2003, because people are like, oh man, I thought we got over it. Now here we are again. It's debilitating for people. I'm just telling you. And so when you look at this in hindsight, you go like, oh man, 1980, 1982, yeah, who was scared about the markets? Well, everybody was. In fact, I'll share with you something here in just a second myself, Amar. But then you look at the S&P 500, just going back to this, on March 9th of 2009, the only person I'm aware of who knew that was a bottom or right around there was Brian Westbury from First Trust Portfolios, because Bernie Frank was bringing on a conference committee to talk about the horrific nature of mark-to-market accounting. And you can see right there, 3/9/2009 was when the S&P 500 and all that bottomed out. No one knew that at that point. No one did. And the irony of it all, it happened to coincide the next month with, show us the next chart, on the various viruses, Amar, because I think a lot of people don't remember what happened in 2009 with the virus situation right after we came off the bottom. Do you have that chart up there?
Yeah, I'm getting it. Just
okay.
Give me a second here.
Yep, this one right here. Absolutely.
So this chart shows the different flus that we've had. And, this, just to highlight, this is as of 2/24. So if we look at our coronavirus, COVID-19, we're probably down somewhere like this, if I were to extend the chart.
Yeah, no, absolutely. But after a month, it's crazy. Never seen before.
These things, we got coronavirus, COVID-19 is going to be here for a while, right? This is not a 1 month thing. And so a lot of these pandemics, I believe it was with SARS, where it was here, summer and went away, And then in the fall, it came back and it was a lot worse, right? So this is kind of gives you a magnitude of what you can see with different viruses here. One thing I want to do is show you another slide here. Now, again, this is a little bit old in terms of data here.
Can you make that bigger?
Hold on.
Or just explain it, because it's a lot going on in here.
Yeah. Well, yeah. So you're challenging my computer skills.
Don't worry. There you go. Right there. Yep. That should. There you go. Yep. Perfect.
So this is compared to other illnesses. What I want you to look at the U.S. infected cases. Now, remember, this is old, right? I said that in the beginning. This is as of 2/24. Right. So, right. So the numbers for coronavirus are a lot higher here, but these numbers are the same. So, I mean, look at this: swine flu.
Yes.
60 million people infected.
Go to the left of where it says year for swine flu. That's H1N1, Amar. See where it says that year? Look at that.
2009.
When do they start recognizing the pandemic? Do you know? Is in April of 2009. What just happened in March of 2009? We had basically bottomed out. And yet right after that, the swine flu came on, and we're talking millions of people infected. 10,000 people in the US were dead. I think it was by December of 2009. That's not, I think it's so easy to overlook that impact. It was, and I don't remember anything about it. I don't. It was nuts. And I got 4 kids, man. Yeah.
And so when we look at this, I wanted to kind of point out a couple other things here on this slide. So a lot more people are going to be affected, right? That's number one. Number two, when we look, so let's look at swine flu for 2009. I'm going to scroll back up to this slide here. So we look at swine flu, it's this purple line here. And you can see the markets continue to go up, right? And I'm going to come back to this when I make my case here. So I'm going to stop sharing this. And let me take a moment to just talk through some of my points that I want to get across here, Josh. And then do you want to kind of go back and forth?
Let's see. Let's see. I think we have. I thought we had a question on here, Amar. How many months of cash? My man Adam says, how many months of cash does someone have as a general rule? If you want to. I mean, I got my thoughts, but if you want to just.
Yeah, so most people, depending on their risk tolerance, will have varying amounts of cash. So we've all heard of 3 to 6 months. If you're taking income from your portfolio, it's probably going to be more than 6 months, because most of the volatility, like we just showed, lasts longer than 6 months. So you really want to, it's situation dependent, number one. Personality dependent. If you're more aggressive, you may keep 3 months. If you're more conservative, you may keep almost a year, right? So there's no single answer for that, unfortunately. But I would say a good rule of thumb is 3 to 6 months, and the more conservative you are, you can be beyond that.
I think too, it has to, I mean, so I work, Amar works. All right. So we have income from employment, essentially. We're both self-employed. So that's more risky than working for when we both work at USAA. I just think if you're retired, you need 3 to 5 years, which I've said a million times a Sunday, just in your buck. Amar, I do the barbell approach. So you got a plate of cash, CDs, or Ginnie Mae, Vanguard Ginnie Mae fund. And then you got a plate of stocks, and the cash and CDs should be enough to cover where you don't have to sell the market when it's down to live on. It should.
Yeah, I think that's the important part, is you don't have to. You want to have enough cash on hand that you don't panic about the market. Yeah. I think that is the most important part. Yep. Some people, even with their savings and with Social Security, may not be able to afford to have 3 to 5 years of cash on hand. Some people may. It's just we define your comfort zone. And your comfort zone is defined by controlling your emotions during these volatile times.
And also too, not having FOMO, fear of missing out. See, that's the thing, man. People, man, they always think there's a better mousetrap, be it the I just, it's nuts. And so what happens is I'm missing out on something if I have this plain Jane vanilla portfolio of S&P 500 in cash or something. Well, I don't care what the portfolio is. I say, man, just stick to your guns on a cash perspective. And when I say cash, I am including Ginnie Mae, CDs, and cash. It's not just sitting in a checking account. It's all that liquid assets.
Yeah.
And just stick with it and be done for sure.
Yeah. And so a big part of that is kind of going into coronavirus thinking that it's a blizzard and it's going to come and go. Hopefully people realize this is not like a blizzard. So I was reading the scientist say, and he used an analogy that the coronavirus will be here for a while. And I think almost 100 million people will be affected, but not all of them are going to die, right? I mean, people can be affected and not pass away. But I feel that it's a season, right? It's not just a couple weeks. It's going to be here for a while. And I think that's important to talk about, because when we're talking about cash reserves, you got to have enough cash reserves that you can weather a season.
Yeah. Yep.
Right. So I want to talk about a couple things. And this is, again, as a chief investment officer for Client First Capital, these are our opinions. And I want to make sure that we know from the get-go, everybody has an opinion, but nobody knows what's going to happen, right? There's always uncertainty. That is the truth. That the truth is that nobody has a crystal ball and nobody can predict the future. And
Amar, you know what else is the truth?
What?
You can't handle the truth.
All right.
I had to say that. How classic was that?
Yeah, and
the Homer Simpson version. You can't handle the truth. Oh.
And so we don't want to sell a bill of goods that we don't know to be true or factual in terms of predicting the future.
Oh, can I interrupt you real quick?
Yeah.
Man, my man's, I don't know if I can say his name or not, but hold on just a second, Mar. You talked to this guy. Our man in Hawaii. He just said I could say his name. Don't say his name because he didn't say. He just emailed me saying, I have a cousin who lives in the Wuhan province, and he posted that life is starting to come back in the workforce. We are seeing a bottom on the drop in cargo shipments to the West Coast, although the damage in shipping companies is starting to show up in layoffs. The officers assigned to China are still working out of our office. There's no hurry to go back. But he's saying he has a guy who lives in Wuhan, and they're starting to see come back to the workforce. So a lot of people are discounting the Chinese numbers. Look, they're commies. You don't trust a commie. If there's anything we've ever learned, you don't trust the commies. But my man here, you talk to this guy, is saying explicitly they are starting to see it come back. But there is a bottoming out, which I think is what we're dealing with right now. I think it is a bottoming out. Doesn't mean it can't go down more. But hey, keep going. I just thought that was who emailed me this. Good info, man. That's fantastic.
So when we have pandemics and shocks to the markets all the time, right? And I think it is something that happens, and it's our reaction to what is happening. When we have people, these are always shocks that are not predicted, right? Nobody can predict, hey, coronavirus was going to happen in the first quarter of 2020, right?
Yeah.
But when we have these short-term events, and short-term being if your time horizon is 5 years or greater, these would be considered short-term events. When we have short-term events, what the fundamentals of the economy are really dictate how people react to what's happening. And so I'm just going to put the swine flu slide back here. So we'll track this purple line here, and we declare it a health crisis here. But from basically, let's say 1 month prior onwards, we had improving fundamentals. Improving fundamentals, people didn't overreact to the swine flu. With coronavirus, I would make a case that we didn't have improving fundamentals. And this is where Josh and I kind of differ, but I'm going to highlight a couple of things. in the last 3 quarters, we had below average US GDP. We have leading indicators that have been starting to slow down. We've had corporate profits also slow down. In the last report, they were slowing down to about 5%. We've also had a tightness in the liquidity market. And one of the things that we saw was an inverted yield curve last year, but we also seen the Fed help the repo markets. And the repo markets is basically overnight lending, right? And it's oversubscribed, meaning there's more people asking for money than there is available, right? So we started to see some of that in December, well, the third and fourth quarter last year into this year. We also saw CEO turnover. And when we typically see CEO turnover, it's because, we have to change gears, right? You've ridden this upswing, and now to reduce headcount or whatever you want to call it, you need to bring somebody else to kind of set the tone for that. The important thing here is to realize that nobody sees these, or nobody can predict these blips in the market. And when you have,
well, they can predict it. They just not gonna be right. Everyone can make a prediction.
Nobody has the ability to be correct 100% of the time. You could have a type 2 error where you are predicting something, it happens to be correct, but your data to predict that was false to begin with, right? So there's all these things that statistically that could happen, but it matters more on fundamentals and the backdrop that you're at. So when we look at this, we can say that the fundamentals were already slightly negative, and because of that, people are panicking. That could be one part of that. And there are different phases of an economic cycle. And when we look at a bear market specifically, I would say, and I got this from another advisor that I was talking to, there's 3 parts of a bear market. And the first part of a bear market is that, hey, the market's overreacting. And retail investors typically try to buy in at this point, right? And this is phase 1. And then phase 2 that we'll see is like, wow, no one could have predicted this. This is unbelievable. This is way worse than what we ever thought could happen. And then we get phase 3, where we start to say, this is the new normal. And we have to start making changes to our models to account for this in the future, right? So those are the 3 phases of a bear market. And right now, I think we're just in phase 1 of a bear market. Josh, you want me to continue?
Just
thoughts?
Yeah, first, I just could care less about what the previous growth or negative growth or earnings, all that. This has nothing to do with it. This is people freaking out. There's no other way around this. This is a panic, and it's more than we've ever seen in this short of time. And that's but it's well due, Amar. I mean, you know this, I know this. We've been around long enough to know we haven't had a real bear market. We came so close in the last quarter of 2018, but a real bear market as defined throughout industry is 20%. We didn't get it. So this is the first real bear market we've had. About time. And for once, we can finally say to the naysayers, okay, you got your bear market. Let's see earnings growth. And the interesting thing was the earnings growth of the S&P 500 was what, 2018, it was 18%, I think, or 19%. Was it 2000? I can't remember. But then it fell to like 5.5%. And what I've always said, if we can get 5% to 5.5% earnings growth plus 2 to 2.5% dividend yield, that's fine. But I still think we have more earnings growth than that. But who knows? It's not recessionary. The whole issue of Amar is we don't know what any quarter earning growth is going to be. I don't really care. But everyone's so focused on the recession as if a recession is doom and gloom. And that's just 2 quarters of not earnings growth, but 2 quarters of GDP negative.
But I mean, I think
not that big of a deal. It's not. And everyone flips out because it's all freaking clickbait. That's what it comes down to. My man Sam is on here, who I love to death. He's a big lib, big Bernie fan, and I'm not. But anyway, he was like, "Oh, are you still saying the coronavirus is a hoax?" We're like, "No, I never said the coronavirus is a hoax. I was saying the clickbait. They're trying to scare everybody to death, and that's what they've done a good job. The media still carries a lot of weight, and I just wish people would say, as I said in the video this morning, there's a FedEx truck going by right now. There's my trash guy. This is a recycling guy going by right now. This isn't zombie land. It's not, and it'll be just fine. But hey, go ahead.
Yeah. And I mean, so when we look at this, companies need a stopgap. And this is kind of to the government's action or what we should be doing now. I mean, we've lost our chance to be like South Korea, right? So we need to do a couple of things to get, I guess, the optimism back up in this country. And I think that really means helping companies produce and still meet their payroll, number one. So companies are trying to see if employees are healthy or not, but they need these testing kits, right? So these testing kits need to get out and need to be more widespread throughout the country.
Someone says, Amar, he thinks you're right, that this is still the beginning. I want to share with you something, my friends. I'm going to show you, my man had posted in an earlier video I did today, how he was buying Carnival cruise. And I want to show you guys something real quick. Carnival. I haven't seen this in a long, let's make sure y'all can see this. If you look at the PE ratio, I'm hoping it doesn't go, but the PE ratio on that is 4.16. 4.16. I'm not saying this is a buy, but I'm saying when I see numbers like that, I get excited because that's what we had in 1979. I'm going to share something with YouTube real quick, Amar. So I'm going to hit share my screen, and I'm going to show you guys something that's going to, let me see if I can't do this share. So I've never shared my screen while I have someone on here. So I'm hoping I can do it, my man. Hold on just a second. I'm going to go to, let's hide this for a second. I've never done this before, but I want to show, oops, hold on, right here. This is the death of equities from Business Week that is infamous, where they predicted the death of equities in 1979. And they said because inflation is destroying the stock market. And ironically enough, they were right. Inflation was destroying the stock market. The death of equities, though, in fact, if you read the article, which this guy, Barry Ritholtz, he had posted verbatim, which I'll put a link in the show notes later. If you read it, it's incredibly interesting what these guys are saying about the death of equities. In fact, I had one thing in here. Hold on a second. It would take another whole second. For better or worse, the U.S. economy probably has to regard the death of equities as a near permanent condition, reversible someday, but not soon. Some guy from SMU Business School said we had entered a new financial age. The old rules no longer apply. And the reason I point this out is because the S&P 500 back then, the PE ratio, my friends, was about 8, literally 8. That means if you have a PE ratio right now, right now I don't even know what it is, probably 16, 17, the S&P. That is incredibly cheap. And with a dividend, with a PE ratio that low and paying a much higher dividend than that we're receiving relative to earnings today, the yield was freaking phenomenally high relative to what we're getting now. No one wanted to touch equities with a 10-foot pole. And I always look at that as my bread and butter when I say, are the stocks going to come back or not? Well, I'm pretty confident they're gonna. Doesn't mean they will. I got no clue. No one has any clue. But the issue is, at the end of the day, we've been through this many, many times. As long as companies continue to make money, come here, buddy. Hold on a sec. Oh, you go over there. As long as companies continue to make profits, there'll be people to invest who will also make profits. And I do not see that companies are going away from making profits anytime soon. So just keep that in mind. You watch the PE ratios. The PE ratio starts getting in the mid-teens. That's a pretty cheap perspective, in my opinion. Anyway, it's not sharing anymore, is it? What are you seeing right? Okay, good. We're back.
Yeah, you see ourselves. Yeah. I mean, look, this is a shock to the system, right? We saw all these airline companies do buybacks of stocks by issuing debt. Right. These are the same companies that are hurting now. And so these companies, I mean, I think I would be not surprised to see some layoffs potentially in the future. I mean, with the shock to cash flow, these companies are going to be hurting from manufacturing all the way to the retail sector. So even if we just look at the transportation in terms of hotels, the vacations, God, I'm losing my mind here, Josh. What do you call it? The sector that leisurely travel,
Hospitality sector.
hospitality. There we go. Thank you. I mean, we're less than 3% of our GDPs from that, right?
Oh, I didn't know. That's an interest. I did not know that, Amar. That's interesting.
Hospitality industry is less than 3% of our GDP, and so yes, it's going to have a shock, but I think, again, there's 3 phases of a bear market. I think we're just entering the first phase, especially when we see these large swings like we had.
Funny, Amar, one of the things about the Schwab Intelligent Portfolios is people always say it has too much cash. And someone's on here, a comment, I forgot who it is. I always kind of chuckle when people say there's too much cash, it's a dead asset, because in times like this, that cash looks pretty good, even though it's a dead asset. And folks, cash is an asset. It is an asset. It doesn't mean it's going to make you anything, if anything, but there is a value to it. Do not forget that cash has a value. I'm telling you. I like the Schwab Intelligent Portfolios. I don't mind that keeps 7 to 8% cash. Doesn't bother me in the least. But my man Richard says, shake hands with an expert or a genius. I put 90,000 in a Schwab Intelligent Portfolio Tuesday, and I'm already down $7,000. And I mean, it's easy to chuckle, Richard, and I'm not laughing at you. Welcome to the choir, my friend, because my portfolio is Mars. Everybody's down, man. There's no other way around that. So the financial genius isn't that you're not one, is that you are just in the markets. That's for sure.
Markets, you're guaranteed to have losses in the stock market. I mean, that's just part of playing the market, right?
My man, Vinyl Earthlink from Connecticut says we enter a new financial age every month now. I completely agree with that too. And we're always hearing this time is different. I do find it. Let me get your commentary on this, Amar. I think the rapid nature of the ups and downs has some effect with high frequency trading. I do. I mean, the old days, you couldn't trade this rapidly. There's no algorithms so much, but it's on both sides too. And it's just, everyone forgets the Dow went up, and everyone forgets, that's high frequency trading too. But
I think part of that is also the speed of information has increased. Even on the individual retail level, right? We have Facebook, social media, and however you get your news, and you get a notification, and we didn't have that before. So obviously volume has increased based off of fluctuations.
I couldn't agree more about the information. One guy says, let's see, hold on just a second. My man Scott says that's the thing, what you were talking about, Amar. He says, right now we're seeing huge drops. When this thing ends, we'll see big jumps upward. I completely agree with that. And this is the issue about people who are already in. Do you get out now to stem the bleeding, or do you say we're already at the bottom? And so for you, going back to your 3 stages, Amar, if we're in the first stage, does that mean the market will still go down some?
Well, let's look at, if we look at right now, we're in the beginning or mid-March, right?
Yeah.
We're about to have first quarter numbers come out after April 15th, right? So if we look at a timeline, what's ahead of us right now? After April 15th, we have Q1 numbers. Q1 numbers, everybody knows they're not going to be great, but relative to analysts, where are they going to stay? And that's a big question. And I think there are some sectors that will be doing well in Q1 because they have this tailwind of business and production coming in from Q4 into Q1. But that is what I think will cause the markets to have a lot of volatility again. And then once we hit the peak, once we start giving testing widely, I mean, I can't stress this enough. The government needs to help support getting testing to every business that's out there, every hospital. We just need to test more. Like our ability to be like South Korea is less and less, and the likelihood that, I don't want to say likelihood. I would say if we have a spectrum and South Korea is on one side of how they've contained and dealt with coronavirus, Italy's on the opposite end. We're going to be somewhere in between, right? And to do that, we need, some backstops to be put in, and this is where, some people have talked about bailouts, some people have talked about workers' protection. Something needs to happen to help businesses continue. Like, I would like to see the Fed say that we're going to provide liquidity and we're going to make sure that we're going to guarantee all existing lines of credit. I think that will do a big thing, because right now what we have is
to existing lines of credit to who?
To businesses.
Oh man, what? Huh?
We have to put a backstop to that.
I
I know you don't like that, but
I don't like it at all. It's nuts.
Yeah,
Forget
but
the freaking companies. Give it to the people. The companies kiss my butt. They're the ones who took the risk, and they needed to suffer the consequences.
I get it, but this is what's going to happen, is that these companies, to make payroll and stuff, they're going to start laying off people, and there's going to be more fluctuations with job uncertainty. And I mean, I have 2 kids. I have a 2-year-old and a 4-year-old, and we've gotten emails from the school saying that be prepared for the school for your kids to be at home for prolonged periods of time.
I don't want. I completely disagree with that. Danielle says she did her Roth conversions on March 4th, and she goes, "I did it too soon." We don't know, Dan. That's the thing. You never know. I mean, being down 30% is a big deal. If you look at Amar's chart he showed before, we don't have that many times in history, a 30% decline. And we don't have any times that we're down this quickly, this much, ever. This is literally uncharted waters, which makes it interesting for sure. What I would like to see, to be perfectly honest with you, I think Trump said, and I'm all about this, is suspending the payroll tax for a couple months. I think that's great, because if you're trying to stimulate the economy, you get it to the people who are paying that tax. And that's why I'm all about tax cuts, because I just all about it. But if you're not paying tax, you don't get any tax cut. So if you want to stimulate, you get to the people who spend, which are everybody, and anyone who's working. Payroll tax got to be done with it. It's a break. I think that's.
I mean that's the same concept of having universal basic income, right? Is to have some cash flow to the people that need it, right?
I think so.
Let's not get on a tangent. So, like, the idea is that people
payroll tax for people who are paying taxes. UBI is for people who are just being a citizen. That's a little bit different, brother.
Yeah, but it's still the same strain on the system.
Yeah, but the payroll tax is giving them a break for people actually going to job, working. UBIs for people who are just sitting around not doing that. And I'm not necessarily against UBI. Don't get me wrong. I'm just sitting there thinking, let's not mix those two, because one is for people who are actually productive. Laborers, people who are doing waitressing and things like that, hourly workers, commission-based people. I got no problem making sure these people are squared away. None whatsoever. The last thing we need is some freaking bankers to go into these businesses and ask for the government to go to these banks, these Hank Paulson run banks, and these freaking, what's his name from Goldman Sachs, and say, we're going to backstop you guys. Nah, we learned our lesson back then, and Hank Paulson, kiss my big fat butt. And that guy and all those guys, Timothy Geithner, they all took advantage of the system, and they all got rich off our backs.
Nobody went to jail.
Huh?
Nobody went to jail either.
Don't even get me started, Amar. Yeah. Don't even get me started. Yeah. My man says government won't accept payroll tax cuts because it bypasses their control of distribution. I agree. This is why we'll never get rid of government debt, which is why I said the other day, because the government teat is quite big, and Republicans and Democrats alike go to it. And that's their means for power. Amar, so Sharon says something that bothers me greatly. She goes, Amar is right. What? Sharon? Come on. She says, Amar is so right about Q1 earnings, especially with cruise line companies. They're likely not done going down yet, but careful if you're thinking of getting them now. I actually think that's a good point. I want to actually elaborate on that, because what happens is, if you look at Zoom, has negative earnings per share of $12. All right. So that means for every share you own, they're losing $12. Carnival Cruise Lines has a PE ratio of 4, but you got to be careful. That PE ratio is backward looking, and like Amar was saying, the issue is of corporate numbers coming out. Was it next? When's the earnings coming out? In April, beginning of April?
Yeah, I mean, so the quarter ends, this month, so it'll
Okay.
start coming after the 15th. I mean,
So if you're looking at a 4 PE now and it's based on the last quarters of earnings, that's looking back. We want to look forward. So if Carnival, I'm glad you brought that up, Sharon, because I don't want to say the PE ratio is attractive because that assumes they're going to make the same kind of earnings going forward as they did last quarter, and that would be silly. Given that there's literally what they say 60 days with no cruise ships or anything like that.
yeah.
Of course, that helps the climate change people, Amar, because cruise ships and planes, they do more CO2 than anything else. So if I'm a Alexander or Cortez or Bernie, I'm like, yay, the economy's coming to a halt. That means CO2 will be reduced.
So
Pablo.
let's focus on stuff that we both agree is that we need to do more testing, right? So we both agree testing should be increased.
Yeah, but so what? I mean, you do the testing, you find out more people have it. I mean, let's just assume you have it. It just hasn't been tested. The testing doesn't bother me as much.
But it's not in the media and not in the market. It's not publicly aware. Like your average person is not aware that we're testing less percentage wise than any other country, right? Like I don't think there's a lot of people out there that understand the severity of coronavirus based off the numbers that are out there. Would you
I'm
agree?
not following what you're saying. What do you mean? Like, it sounds like you're saying the testing would make people more aware of the severity of a coronavirus. But I think the exact opposite. But anyway, elaborate on that because I'm not sure I'm following what you're saying here.
Yeah. So I guess okay. So what I'm trying to say is that the news is all over coronavirus, right? And when we get more testing out there, there's
Right.
going to be more people that test positive to coronavirus.
Right.
And so there'll be more negative news about what's happening due to coronavirus. So going to the bear market question earlier, that we're in phase one, phase one is going to continue for a bit, is what I'm trying to say.
Okay, but I don't. What does that have to do? I'm still. What I think if they did more testing would show you the lack of severity of it in terms of deaths. You know what I'm saying? So like
that's true too.
The WHO with Roger Daltrey, the World Health Organization published a stupid press release that said the death rate is like 3 to 4%, which is freaking stupid. They should never have done that. It was dumb because they didn't have enough tests. So if we tested, look, if they want to do that, I'm fine with that. But it shows you that not many people are dying from this. That's so if they want to test it to actually calm fears about people dying, I'm all about that. I just don't think it's I don't think it's that urgent that we see this because the people who've done the test recognize what because like 0.5% is the death rate. I mean that's bad, worse than the flu. But and everyone says you're being flippant on grandma who's dying. No, I'm not. It's bad, but it's not bad enough where you say the freaking world. It's not the Spanish flu. It's not even H1N1 in terms of the number of deaths. It's not. And then on top of that H1N1, Amar, don't forget, that wasn't old people. That was anybody. That was a lot of young people who were healthy. I sit back and I look back at the articles from 2009 about swine flu, and I'm sitting there thinking, that was friggin' scary, and I wasn't scared. And I just sit there, and the reason I wasn't scared is because the media hadn't pushed the panic button. And that's ultimately what it comes down to. The media's pushing the panic button because of a certain occupant in the White House. I completely think that's true. And if it had a different occupant in the White House, Barack Obama, they would have done just like they did with H1N1. Move along, wash your hands, don't worry so much, and you're gonna be fine. And yet H1N1 was so much before it passed. There's so much. Yeah, it's just it's too bad. We're breeded for negativity. We are, and it's easy to fall for it. And yeah, I just
so two things that we're doing. So the government's going to help. Feds reduce interest rates, right?
That doesn't do crap,
and that didn't do anything. But any president in an incumbent re-election year is going to do everything they can to get the markets back up and the economy back up. And so I think when we look at this from a 5-year, 10-year perspective, that will the markets be higher than where they are today? Nobody has a crystal ball, but is the probability that we're putting in things to boost job growth, boost the economy? I would say yes.
Yeah,
So what one of the things that we're recommending is people should rebalance to their target allocation, right? And we do it at certain trigger points. So we look at 15, 30, 45. And then after a 30% drop, you should really start to have conversations if you can handle more risk, right? So add to equities, like your friend earlier was buying Carnival. We're recommending this to take on more risk after 30%.
This guy says he should have invested in Charmin stock. Do you all not remember the video I did a month ago talking about Clorox? Yes, it's true. I did a video, Amar, on Clorox bleach. Where did I get that idea from? My beautiful, beautiful. She says, you should invest in Clorox bleach. I said, really? Because the reason was because her sister is a nurse practitioner in South Carolina and was saying, man, this coronavirus, people are worried about it. Everyone's I can't remember what the whole point was. That's interesting. So you never know. I just, the stupid toilet paper stuff. We had a neighbor down the street. He had a big pack of toilet paper on his front porch. I said, man, you look, trust me, no one needs as much toilet paper as I need with our household because we love Mexican food. Let me just tell you, Mexican food will tear you up if you know what I mean. And we're not stocking up on toilet paper any more than we normally do. That's for sure. But I agree. If it's the market is down, I think the S&P, the last we looked was at 20. It just was at 2507. Now it's back to 2514. If it gets to 2350, that's my prediction. That is capitulation. That is a 30% decline at 2350, and we're about 180 points off of that. So once we get to 2350, I think for me, I think that's probably the bottom. But who knows? You know what I'm saying, Amar? I don't know. But going back again to the reasons you want the bucket approach or cash on the side or diversification, remember, folks, diversification doesn't help when everything is falling. And that's why I don't care what anybody said. What's gold been doing? I haven't watched gold. Have you been paying attention to it tomorrow?
Down, but not as much, right? I think it was GLD was down 4% yesterday. I don't know what today.
Yeah, it's down 3.3 today too. So gold is off, from 160. 159 is down to 148 today. So, I mean, it's not off huge, but still, I mean, see, it's just this is what we learned in 2008. When the market's panicking, everything goes, there's 100% correlation downwards in a panic, except for government bonds. And if we look at Ginnie Mae, for instance, let's just take a gander. Ginnie Mae, oops, hold on a second, Amar, let me just look at my list here, is up. Where is it up? Let's see here. No, Ginnie, that's not Ginnie Mae. Hold on a second. VFIIX. Ginnie Mae is like government bonds were actually off the last couple of days. So Ginnie Mae has gone down. Was that not very much? 0.28%. That's the Ginnie Mae. So that is the reason you keep government bonds as opposed to corporate bonds, because if you're going to be diversified and the stock market falls, corporate bonds are going to fall too. Anybody have any questions for Amar? We've been on here for about an hour. So
can I play my disclosures, Josh?
Yes, please. All right. So this guy says address leveraged S&P. That's a good one. Let's address that. Player disclosures real quick, Amar.
Right. Thank you for listening to the Savvy Wealth Podcast. Click the subscribe button below to be notified when new episodes become available. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into.
Is that it?
No, it's supposed to keep going. I don't know what's going. I'll try to reload it. Maybe we do it at the end.
So real quick, I'm not a fan of leveraged the bear market 3 times. I've just not, and the reason is if it's every single day. It's a new day. It's a new leverage. A new day. It's a new leverage. I'm telling you, I learned the hard way back in 2000s on the Qs, and it used to be triple Q. Now it's the quadruple Qs. It's not if you think the market's going to go up over the course of a year or a course of a month that you're going to get 3 times that, or on either side, the down or the up. It's on any given day are you getting the triple leverage, and then the starting of the next day you're right back to zero. So I just look, man, I'd be careful in that. You have anything to add to that, Amar?
No, I agree with you. So it's on a daily basis, like you mentioned. The other thing is that if you do hold it for time, then you're not going to get 3x on the upside. You'll get 1.9. And on the downside, you'll get 3.5 or 3.6, right? So you have more downside than upside. Anything held for short-term gains in a taxable account is, your capital gains treatment is short-term.
Yeah.
So even with that leverage, I mean, you're still going to pay a lot in taxes. So, also depending where you hold it makes a difference as well.
Well, Amar, which firm do you work for, says Tom?
So I'm an independent advisor. So I have no association with any big firm. Well, I shouldn't say that. We custodian through Fidelity and Schwab. So we don't actually hold your accounts. We're just advisors for people that have accounts at Fidelity or Schwab.
But you own your own firm.
I mean, I own my firm. Yes.
What's the name of it?
Client First Capital.
Okay. And website?
ClientFirstCap.com.
ClientFirstCap.com. Probably just scratch me. Not capital. So ClientFirstCap, CAP.com. And Amar is you're registered, whatever license in all 50 states.
All 50 states. Yep.
Can you say that you just went through an SEC thing, or you got to keep that?
Yeah, I mean, so I
mean, everybody gets audited. Amar just.
I just. Well, I'm in the middle of it, so let's see what happens.
Yeah. So what happens when you're working? When you're when you're an independent investor advisor, an RIA, which is a registered investment advisor, the SEC comes down to make sure. I don't know, Frank, what they're doing. I guess they're making sure. Who knows? But Amar just went through that, and I'm just gonna anyway. He's fine. It shows you that Amar is on the up and up because the SEC just reviewed his docs. Amar does manage money, my friend. So if you do not want to do it yourself and you want a guy like Amar, look, I can't recommend him because I don't know what the SEC would say about that, but I certainly say give him, look over. I have no idea. I have no idea his performance. Don't care, frankly. I know I trust Amar. I like him. Amar's not. He's one of the good guys. Let's put it that way. He's one of the good guys in San Diego. But even if you're not in San Diego, you can call him.
Yeah, I appreciate it, Josh.
Last, Vinyl Earth Link says the SEC is very picky about technical violations. Yeah, man. Yeah, but if you're a crook, the SEC won't bother you. I completely agree. Amar, don't say anything on that, but I just. All right, well, it's been an hour. Appreciate y'all being here. Amar, like you, ClientFirstCap.com, and I guess that's it. Hang tight, my friends. It's gonna be a bumpy one, but this is the nature of the beast when you're investing. You gotta stick to it. There's no other way around that. All right, we'll see you guys.
All right, and Josh, I'm gonna try to play that disclosure again, or no?
Yeah, might as well.
Yeah.
You don't want to be in trouble with the law, man.
Yeah, I'm trying as we just talk about the SEC here.
Pablo is.
I don't know what's happening with.
Well, we got it. I mean, it was in here, Amar. I mean,
yeah, we tried. A for effort, right?
We literally have the disclosure in there, so you're fine, man.
All
right. I'm gonna hang up on this call, so we'll see you guys. Thanks. Now, don't forget Sunday live stream 7:00 Eastern time. Sunday, be there or be square, unless I don't show up because I got sick. See ya.